guys, Brian Stevens here with the National Real Estate Post. I have Dave Stevens with us today. He's the past CEO of the Mortgage Bankers Association, the past Federal Housing Commissioner, and he's the current CEO of Mountain Lake Consulting. How's everything going, Dave?
It's going great, Brian. Long time no talk.
Yeah, exactly. Hey, here's the big one that we're hearing from lenders that we need clarity on is, Ginnie doesn't seem to be going well. FHA, like locking FHA deals are kind of a problem. Jumbo loans have frozen up. Non-QM has gone away. I want to give you, again, a wide berth on this whole thing. What's going on with Ginnie, Jumbo, and non-QM? Can you give us some clarity on that?
Sure. First of all, I would just say that, we're in the apex of an event that literally blew up over 3 weeks. Really closer for our industry, 2 weeks. So it's that concentrated a period of time. And the thing I would just remind everybody in our business, it was at the perfect storm moment, right? Your pipelines are max full. You're just wondering how you're going to keep up with all the loan application volume. So you're at the peak of production, and then suddenly the whole thing collapses due to coronavirus. And the administration announces a big forbearance program, which says, hey, what's that mean? What's it going to cost? I'm not even sure as an MSR buyer if I can even put a bid out on servicing. So I just want to highlight to everybody right here at this moment in time that we're in a moment in time. The good news is the Fed came in guns a-blazing in an extremely positive way, and that's why you're seeing what's going on in the stock market the last couple of days. And that's why you're seeing mortgage-backed security prices improve dramatically. I understand mortgages are not necessarily improving overall, but mortgage-backed security prices came into play. I love Rob Chrisman's blog, and this morning it was he had a great one-liner, which was, "Hey, your prices are not in line with what I'm seeing on my screen." And the investor says, "Well, then sell it to your screen." So here's where we're at. Here's where we're at in reality, and I've spoken to executives across the country. We've been working on this nonstop, starting really last Friday when things really began to implode. Working all weekend, talking to heads at FHFA, at the GSEs, and a lot of institutional buyers and sellers on both sides. The co-issue market is basically gone for right now. Getting the non-QM market has completely collapsed. I would just think about vanilla. If you like vanilla, you're going to be great. If you were getting excited about the new spices and toppings coming on the flavors of the day over the last few months, give it up. That's not coming back for a while. So non-QM is gone. The non-agency market's going to be really hard to get a good bid out of right now. It's going to be whole loan only, and I'm not sure how anybody really buys one of those mortgages in today's current environment for a couple of reasons. One of which is they're not sure what the performance is going to be of these mortgages, given all the new unemployment data and how that's going to impact the markets. They're not sure what it's going to mean to home prices, because the home prices that will probably get hit with the hardest burden here will be the high-end homes, and then duration is just an unknown bet. So that's a really tough market. So we're going to be living in a Ginnie agency world for a few months here. Let's say through most of the rest of this year is what I would expect. Problem in the Ginnie space is you can't really get a bid on new production. If you had pipelines that were already pre-committed to investors of current production, most of those investors are following through on whatever locks you put in place if you were covered. If you're uncovered, it's a difficulty. And I spoke to an independent mortgage banker today who put out a pool of Ginnie production for settlement, and the bid was so bad they just pulled it back. They're putting out a bit of agency today, Freddie Fannie stuff. They expect that bid to be better met by market conditions. So we're in a tumultuous period at the apex of the crisis, with literally everything piled on, and it's happened in a really compressed time frame. I mean, to put it in perspective, and I'll shut up in a second, Brian, but to put it in perspective, if you think back to 2008, when the GSEs were put into conservatorship, and that was kind of considered the year of the peak of the last Great Recession, we actually had about a year in advance where we saw institutions fail in 2007. It bled into 2008. Suddenly it all collapsed. Congress had about 3 months to put together an incredible piece of legislation that led us into transition from the Bush administration into the Obama administration. Our team comes in and we start implementing all this stuff. But that seemed like a pretty short period of time. That doesn't compare to what we're in right now. This is an incredible encapsulated series of events in the most extraordinary short time frame. And frankly, I think the Fed's big guns, what Congress did last night, and from a legislative standpoint, was huge. I don't think it'll be enough, by the way, but I think it's been a huge start. So that means you're going to have volatility. Close out your pipelines the best you can. Keep focused on your relationships with your referral partners, because they're freaking out. Realtors, home builders. I'm joining a bunch of calls with folks like that over the next couple of weeks. And just be focused on the prize at the end of the tunnel here, which is we're going to get through this. And as we come out of it, it's going to be an impaired economy, but the housing economy is going to be pretty good and stuff will start flowing together. I can talk you through any piece of that you may be interested in.
How long do you think it's going to take for the non-QM market to come back, or the jumbo market?
I think the non-QM market is going to be the longest period of time to come back. And I just think, it was barely trickling in anyway. It was a very small percentage of the market. It had actually doubled year over year from 18 to 19, and then we were expecting it to double from 19 to 20 again, but it was still only going to be about 5% of total market. I think this has basically dried up any interest in credit risk or providing liquidity to that market because of the way those loans are underwritten. There's just a lot more volatility in the outcomes there. So, I think the Ginnie market's going to be a challenge for a period to come. In general, just to get MSR, servicing buyers to give a reasonable bid. And then the jumbo space, I think, once we come out of the virus, we're not going to be out of the virus for probably well over a year from now, but with any kind of cure per se, but we'll at least be we'll be past the curve somewhere towards year end, fourth quarter. And under those conditions, I think you'll begin to see jumbo investors come in with a better understanding of what unemployment data looks like, what at-risk professions may have been impacted here, and what sort of is happening with home prices. So I think that's sort of a fourth quarter event where we start to maybe see some reasonable return of the non-conforming space.
So with uncertainty in employment and forbearances on mortgages right now, why would somebody write a loan, especially in a what's considered a higher risk space like an FHA loan?
Yeah, well, that's a good question. It's a well-known large buyer of mortgages who I think most of your listeners probably sell to. Said, I don't know why anybody would take a bid on a Ginnie MSR. The thing, I spoke to a reporter a little while ago who's writing a story, and I was trying to explain that there's no underlying risk to that servicing in a forbearance agreement, right? The mortgage is guaranteed by FHA, as it is with the GSEs, or by rural housing, or by VA. If it's wrapped by a Ginnie, it's got a full Ginnie wrap. But we're in a cash imbalance, right? Because in a forbearance program, which is going to be 180 days, now we're going to see what percentage of Ginnie mortgage borrowers opt in, and the opt-in capability is a lot easier than what we saw in the last recession, because you don't have to prove hardship. You just have to attest to the fact that the virus has impaired your ability to make your mortgage payment. If that's the case, depending on the take-up of forbearance, we now have servicers all around the country who have to make most likely 180 days of advances to Ginnie and bondholders, and they're going to have no income coming in. So that's a huge pot of money, and that's where this liquidity facility and the legislation that was passed yesterday, getting that to be very flexible and wide open, particularly to non-bank servicers, but to bank servicers as well, is going to be critical, because these loans are not riskier loans. I mean, they're not riskier because of who's servicing it. The non-bank doesn't mean it's a higher risk transaction. It just means there's a delta between when they have to make the advance to the investor and when they get repaid by FHA or VA or Ginnie ultimately, and to be made whole, because all that money is all that mortgage product is insured. So in the short run, until the forbearance plans are understood, and servicers understand what this means to duration and their access to liquidity, those are really important points, you're going to see really bad bids on Ginnie servicing. And that's going to be at least for the next, week or so till we get a better understanding of those components, because they're working frantically to get that liquidity facility, the guidelines around it and how it's going to be used and under who has access to it and under what terms, and are there haircuts and are there fees and what percentages and those kinds of things. These are all really critical to understanding the economic hardship. But it's if they do it the way I'm hoping they'll do it, then we're going to have a good liquidity balance sheet accessible to bank and non-bank servicers on a sort of as needed basis where they'll pledge the collateral against it, and they'll be able to make the advances to the MBS investors. And then it's just a matter of watching the clock. And then ultimately, in the end of the day, some will go into foreclosure. We will have a spike in foreclosures. I don't think it'll be as bad as most people think, but we'll have an increase in foreclosures. And then others will begin to reperform, and the balances will be tacked on the back of their mortgages, and we'll be back to the races. The reason why I'm a little bit less pessimistic on this whole portion of the collateral bandwidth is we have a shortage of supply in entry-level housing in this country, and the demographics haven't changed. And so there's sort of a natural floor to what can happen to home prices. So anybody in an FHA home, per se, and this is a national scope view, and I literally just got off a phone call with a well-known economist in this country who's held a call for about an hour with a whole group of folks to talk this through. But he was also making the same case that there's a natural floor to where entry-level home prices are going to go. That's very much the Ginnie Mae portfolio. And so from that standpoint, the collateral will be relatively safe. Because of forbearance, those that get back and start their jobs all over again, they have nowhere else to move. They're going to want to keep that house. And it just gets tacked on the end of their balance. So they'll pay it back when the loan gets refinanced or the home gets sold. And so we will have an impairment for those that didn't get reemployed and had to go into foreclosure and they had no other option. But it won't be to the scale, I do not believe, ultimately transitioning into foreclosure that we saw during the Great Recession.
Just kind of going back to servicing here, one of my good friends, Michael Fisher, he wanted to ask a question. He said, how do EPOs and APDs relate to Ginnie liquidity and lender contracts?
Well, that's a good question. And there's a question also on the agency side along the similar lines. And I would just say you need to refer to your contracts. But if you have repurchase obligations on EPDs or EPOs, I think that's going to be something that needs to have be negotiated. The way most contract language is written is that a forbearance is in itself a default and then counts as a default, even though they're going through great pains in this legislation to not have a count against the credit of the borrower. But the policy of forbearance, both for Ginnie programs and for the GSEs, I think constitutes that as a defaulted loan, in which case it's not eligible for sale at all. And if you have an EPD contract or an EPO contract that says 120 days or whatever the number is, you have to buy it back. I would just say that's something that your company has to negotiate with whoever you sold it to, especially if you went through a correspondent or depending on how you ultimately originated and transacted that Ginnie loan. And this is going to be a really big deal. I spoke to a senior executive at one of the GSEs over the weekend, and he was relaying to me how our forbearance program, there's a lot of loans that are closing this month, right? We have a huge pipeline still closing for across the country, believe it or not. And there are going to be a bunch of first payment defaults on those mortgages if they're offered a forbearance plan on day one. Well, that technically becomes a default. You have two things going on then. Am I obligated to repurchase that because of a first payment default? Or two, can I even sell that loan? Like if I've already funded it, it was approved, met all the criteria, got a PIW on a refi through Fannie or Freddie, I mean, whatever it was, but it's now defaulted technically because it's in forbearance, even though that's a federal program and we're not supposed to count it as defaulted. The policy says you can't sell it. So now I'm stuck holding a loan, or maybe a bunch of loans that had a first payment default. So these are all things that are being worked on. I will tell you that many of us who are in conversations with policymakers are saying, look, you got to have a new rule book for this temporary period of time. You can't go to the programmatic policies of forbearance that are written in your manuals. This is a once in a lifetime event. I never thought we'd be saying this is another once in a lifetime event, but this is another once in a lifetime event. And it's going to require an extraordinary response. And that my advocacy is that for the GSEs, that they should hold those loans as whole loans on their balance sheet. And if they need to take a draw from their line of credit from Treasury, I mean, that's sort of what that should be there for. But we should not put a bunch of companies in America at fault because of a virus that nobody anticipated would put the markets where they were. We need to keep the system functioning, and we need to keep trust and confidence from everybody who participates in this system, from MBS investors to servicing buyers, to originators, to regulators, to ratings agencies, and more, that this is good collateral, because we're going to bounce back from this, particularly in the housing sector, particularly in the entry-level portion of housing, pretty quickly. So that's a real problem. Again, if you have a corresponding contract with somebody though, and it's got a EPO or EPD clause to it, I think that's going to be a challenging negotiation that I think will be handled case by case.
You know, there's with our hyper means of communication with social media and all the outlets that we have to engage folks, there's a lot of rumors going on right now. There's, I'm sure there's certain facts that are within those. Is there anything as one of the industry leaders that you would really like to convey to anybody who's writing a loan or running a mortgage company today? Is there any just, kind of underlined statement or something?
Yeah, so here, I think it's a good time for people like you to be out pushing messaging. The economist I was just on the phone with, I don't want to mention his name because I'm not sure he'd want that out there, but well known. It was a large pool of investors talking to him, and he said he was shocked at how many economists are saying this is going to be the next Great Depression. He said just how irresponsible it is. And he went through the fundamentals of the economy and how we entered into this space with a super strong economy, and how the measures that happened legislatively and by the Fed, which has been extraordinary, cushioned a massive blow that could have hit. And while we think there'll be another stimulus package needed somewhere around Q4 or Q1 for different reasons, not necessarily related to housing, that we're going to get through this thanks to that response. For mortgage people, you're still in a month, we're still in March, right? Big pipelines. Yeah, there's been some fallout, I'm sure. But for the most part, you're in businesses that are functioning. You've got pipelines you're going to get that are going to fund them. We're coming off some of the best months that we never expected that we'd be having a year ago at this time. So I know you're scared and everybody's worried about what may happen here, but we're in the best position to come out of this because once we get past the hump and people do return to work, we will have unemployment up. It may go up 4 or 5, 6%, but it isn't going to be the 20 or 30% kind of long-term sustaining unemployment. There's going to be a pop back in GDP, in economic growth, quarter over quarter. The first quarter we're back. That'll be probably fairly significant, simply because everybody's going to be back to work. I mean, right now we have no productivity, which is crazy. And it's not zero productivity because you're working out of your home. I'm working out of my home. In my consulting business, I'm still getting paid. Everybody in the mortgage business is still working out of their homes. And so we've still got things working. So yeah, I think we're going to have a few hard months leading into sort of the middle of summer. If the summer wane happens against the virus and people have returned to work by then, we will have an economic hit, but it won't compare as in terms of how bad it was to 2008 because the Fed stepped in a big way and took out the excess supply by buying MBS, and they've stepped up the purchases drastically. That's why you saw bond prices improved by almost 200 basis points in a day.
Yeah.
And then, and you're seeing the market response. And then all of the bailout capabilities that are being brought to consumers, not just with the $1,200, but really the unemployment piece where you can get up to 4 months of your full salary paid in unemployment benefits. Now, there are other problems here, Brian, which, there's some analysis that shows about half of the states' unemployment insurance balances would not survive anywhere near a hit like this. So there are going to be monies needed to flow into state coffers, et cetera, just to pay on unemployment insurance benefits. But the blow has been massively cushioned as a result of the fast actions from both the Fed and Congress. And it doesn't mean there aren't going to be a lot of players hurt. We've seen non-prime companies have closed their doors or stopped lending. And I think, I worry about some warehouse lenders. I worry about some servicers. And we'll see what happens in that space. But on a broad scale, macro level, U.S. Sort of view, I think if you're in the mortgage business, I'll take that over almost any other profession,
right?
Because when we come out of it, rates are going to be low for a long, long time. The Fed went to zero, and they're going to stay at zero for a long time to get this market back on track. That's going to mean, there's going to be low interest rates, and our economy is going to fare far better than Western Europe during this period, as well as Asia. So there's going to be a big flight to quality into bonds as we move into recovery. And so you're going to have low rates. You have a floor kind of on entry-level housing due to shortages of supply, which we now can be thankful for. And the demographics of people needing to live somewhere haven't changed, and we'll have most of America back to work again. So this is a short-term crisis, and people can accuse me of trying to be too positive here, but we've got to contradict a lot of the exceedingly negative views coming out, because it's hyperbolic, it's emotional, and it's not really based on fact. So we need to ride the suit. So if you're in the business, stay in the business, fund your pipeline. There'll still be some refinance activity. It's going to look a lot more vanilla than it was looking over the last few months, but do that. And you're going to wonder why your rates aren't as good. And that's fundamentals, man. I mean, there just aren't buyers of duration right now because of the risk, but that will mellow itself out as people get more confident in terms of what this all means to unemployment, default rates, and payoffs and things of that sort. So we're going to understand this situation a hell of a lot more clearly in just 60 days. And so it means we got to just hunker down and hold on to what we got, because we're in a business that's going to do really well on the backside of this, just like it was doing over the last couple of months.
Yeah, I looked at this, and just kind of in a real ironic tone, as in 2008, we were seen as the heart of the problem. And, here we are in 2020, we could be a shining example of the solution to the problems that we're facing right now. And
Brian, what I've always said, and I think this is I hate to say it, our industry tends to do better in bad economic times, because it becomes a primary source of focus for policymakers, because they want to fix the housing market because it's such a big part of GDP. And two is normally when you have an economic slowdown, your rates slow down with it. It's only been violated once, which was an inflationary recession due to the oil patch crisis. But other than that, rates go down, and that's the forecast here. Rates are going to go down. So there'll be refinancing, there'll be purchasing coming back in. Demographics haven't changed. America will be back to work. We will have a higher unemployment rate because there'll be some businesses that failed, but that itself will be sucked up in a fairly short period of time. And you're going to see economists projecting that, late 2021 and 2022, we could be, we could be back at the races full time at that point from an economic standpoint. So.
Well, it's like what you're doing. It's like what you're doing and what I'm doing right now. In the meantime, hunker down and just try your best, right?
Absolutely. You got it.
Hey, listen, if you're watching this right now, this is great information, not only for lenders, but for realtors and even your clients. I mean, we need to be getting great information out. So if you're watching this right now, make sure you share it with your sphere of influence, your personal ecosystem. Great information is what we need right now. And with that said, Dave Stevens, thank you so much. It's wonderful talking to you again.
Likewise.